Good morning. Well, I say good morning. Some of you are probably in other parts of the world where it may not be morning. But anyway, welcome to our first in our Finance for Expats webinar series. This first webinar is Effective Wealth Management as an Expat. We're joined by Jonathan Ralph, Senior Associate at Holborn Assets. Welcome, Jonathan. Jonathan will walk you through the fundamentals of good wealth management as an expat. I will hand over to him in a moment and ask him to introduce himself. You can put your questions to Jonathan at any point. You will see a Q&A button at the top of your screen, and he will answer any questions as we go along, or at the end, whichever becomes more convenient. Any that we're unable to answer during the course of the webinar, we'll cover after the webinar, send you a response by email. So if I could hand over now to Jonathan, if you'd like to introduce yourself and take it away.
Excellent. Thank you very much, Nigel. Good morning, everybody, or good afternoon, or good evening, depending on where you are in the world, of course, as Nigel just alluded to. I'm just going to share my screen now. I've got a little bit of a presentation to walk you through. It's just going to underpin today's session. It's not going to be a bore fest, trust me on that. But it will help for you to see what I'm talking about. So if I just share my screen, and Nigel, if you wouldn't mind just confirming when that comes up, so I know everyone is looking at the right material.
That's up. Okay.
Excellent. Okay. So as Nigel kindly mentioned at the top of the show, my name's Jonathan. I'll be your host for today's first webinar in the Expat Network series. The topic is going to be wealth management essentials for expats. We're going to need around half an hour today. We'll try and keep it as short and sweet as possible. I will be able to point you in the direction of further reading if necessary, or you can always get in touch with me, with any of my colleagues at Holborn Assets, of course, with the good people at Expat Network. And then we'll be happy to go through any specific scenarios that you might need any guidance with. Before we get started, as Nigel kindly mentioned, I would ask that if you have any questions during the session, please do pop them in the Q&A box that you have in the Zoom webinar feature. We will get to those at the end, where we'll be holding a Q&A. So that will be in addition to the half an hour that we'll be covering the main content in. So yeah, without any further ado, let's kick off. Okay, there we go. So by way of introduction, this is going to be the most boring slide of today's session, I promise you, because it's all about me, but it is important that you understand a little bit about who I am, where I'm coming from. So my name is Jonathan, Senior Associate here at Holborn Assets. More on Holborn Assets in just a second. I'm a fully qualified, licensed financial advisor to expats all around the world. I've been an expat for the best part of a decade myself. However, I qualified back in the UK. I'm currently based on Mallorca in Spain, have been for the best part of 5 years now. But like I say, working with expats all over the world, helping them to ensure that their finances are planned correctly. So if you'd like to contact me at any point, you can see my email address and my mobile number on the screen there. It will come back with the final slide of today's session, so not to worry. You will be able to see my contact information afterwards. I mentioned that a quick word on Holborn Assets. So we position ourselves as the financial services group of choice. The reason for that is that we can point to a long track record of putting our clients first. We pride ourselves on exceptional service, putting the right money in the right place in the right time. What does that mean? Well, essentially, that means being with you for all the major financial milestones in your life. So our areas of specialism are pensions, financial investments, property investments, specializing primarily in clients in the offshore market. So that's to say our core market are expats just like yourselves. You may not have heard of us, but we are one of the largest financial advisories worldwide. We serve over 20,000 clients in more than 100 countries now, manage over $2.5 billion of their assets. So naturally, as a client-centric business, we are regulated in our markets of operation. So that includes by the Financial Conduct Authority in the UK and in the EU via our European head office, which is actually in Cyprus, and in other jurisdictions around the world where we operate. We're multi-award winners, and you can see some of our most recent awards on your screen. It hasn't been updated with very recent awards we've just picked up in 2021, but it's all very much of a muchness these days. We are also extremely proud of our 4.8 out of 5 rating on Trustpilot, which puts us very firmly at the head of the offshore financial services market. I mentioned that we serve clients in over 100 countries, and you can see our major offices on the right-hand side of your screen there. Of course, as I mentioned, I myself am calling in from my practice on Mallorca today, so I'm hoping that my small little office will earn a spot on this particular graphic over the coming years, but these are our primary centers of operation. Okay, so that's the boring stuff out of the way, who we are. Right, today's session, like I mentioned, will take around half an hour. These are the topics that we'll be looking at. So what we're going to do is we will start with the basics. So what is your tax residency position? Where should you be paying tax? I personally have been staggered by the number of my own clients that didn't have clarity on this when we first spoke. And it's really important that you understand your tax obligations before taking any kind of financial planning decision. So that's number one. We'll then look at the tax treatment of your UK assets, so that you can see what happens when you move abroad. This will include bank accounts, ISAs, any premium bonds you may have, of course, your pension. The tax compliant savings options that you have in the UK may incur a much larger tax bill in your new country. Fortunately, alternatives do exist to ensure that you're saving efficiently, so we will explore this a little bit later on. And I must say, a quick note for any non-UK expats watching the session. I know that we have a few of you in today, so welcome. I know this section has a bit of a UK focus, but the principles that we're covering here will also apply to you. So stay with us. Let me know if you have any specific questions with your assets in your home country, and we will come to them at the end. I believe we've got a couple of Americans in the house today, so your situation is a little bit more complicated. We can go into that if there's interest. So do just pop a little question in the box, and we will come to it at the end. Next, we'll get into the real meat of today's session, which is how to build a prudent financial plan and live the life that you dreamt of when you first started planning the move. We'll break this down into three main sections: short-term savings, medium-term investments, and longer-term retirement provisions. As an extension to this topic, we'll then look at the tax planning opportunities available, focusing on tax-compliant investment vehicles that merit consideration. This means looking at offshore investing. Don't worry, everything that I show you here today is completely legal and above board, regardless of what you may have read about offshore investments in the press. We'll then look at a quick case study using the example of an expat in Spain, which is a fairly common example. Finally, we'll analyze a key question. Is it better to rent or buy a property here or there when you move overseas? You might not have been expecting this topic when you originally signed on to this webinar, but you may be surprised by the answer. So it is worth considering for just a few minutes. And then once we're done, we'll wrap up with some Q&A. So hopefully this is along the lines of what you're expecting from today's session. So without further ado, let's crack on. Right, kicking things off then with tax residency. As I said, it is critical to understand your residency position to make sure that you are paying taxes in the right place. Failure to do so could mean overpaying, or worse, punishments for undeclared or underpaid taxes. This is tantamount to tax evasion in most countries, including Spain, where I'm currently based, so it's important that we get this right. The first rule of thumb is the 183-day rule. So if you spend 6 months or more in a country in the fiscal year, and that's the fiscal year of that particular country, then you are legally resident in that country for tax purposes, and you must pay your taxes there. Be mindful that some countries operate different fiscal years. The UK, for example, is April to April. Spain is January to December. And there are other minutiae to consider when going country to country, but that's quite a niche topic, so we're not going to go into too much detail on that today. Some people don't spend 183 days anywhere in a year. For example, yacht crew or digital nomads or other frequent travelers. This may concern you. If this happens, some country-specific tests will apply to determine your tax residency status. Now, this starts to get a little bit complicated, so it's best to speak to an advisor if you're unsure about this. However, I imagine that most people in the session are spending 6 months of the year in a given place. So I'm assuming it's not going to apply to the majority of you, but we can come back to it in the Q&A if that's not the case. Once we've defined your residency position, we need to know how to declare our taxes. So we don't want to be paying taxes in other countries unnecessarily. So first, if you have an income in another country, for example, from a UK private pension, if you're choosing to keep your pensions in the UK rather than transfer them to Europe, of course, here you can ask for any income to be paid gross of tax so that you can declare it in your new country directly. Where this isn't possible, and it's not possible in a number of cases actually, you can reclaim any tax already paid as a tax credit when declaring in your new country of residence. This does require, of course, that the two countries have a double taxation agreement, sometimes known as DTA, if you ever see that written down, DTA, double taxation agreement. If they do not, then unfortunately you may end up paying tax twice. Fortunately, however, most developed nations do have a DTA in place between them. So how these double taxation agreements actually work is that if you overpaid for tax in your former country, if you paid tax in your country which isn't necessarily what you should be doing because you're tax resident elsewhere, then you can claim back a credit for the amount that you would pay in tax in your new country. So in other words, there is no rebate for any overpaid tax. If you're paying more tax in your old country than you should be in your new country, there is no rebate for that. So do watch out here. In addition, if the tax due in your new country of residence is higher than what it otherwise would have been or what it has been in your former country, then you must actually pay the balance. So you must top it up to make sure you comply with the tax levels in your new country of residence. And as we've discussed already, the tax credit system is the mechanism used to ensure that your tax position is fair. So one to be aware of when you're looking to pay your taxes. Okay, moving on to practicalities now. So talking about tax can feel a little bit intangible and dry. So let's cut to something a little bit more visceral, shall we? What happens to my assets when I move overseas? Again, looking at this from a UK perspective, just to try and keep this simple. So let's take this step by step. Number one, bank accounts. Not a lot should happen to your bank accounts when moving abroad, but do make sure to let your bank know to avoid any missed correspondence and unnecessarily blocked cards, which can leave you in a bit of a bind. You will, of course, lose your UK savings allowance of up to £1,000 tax-free interest. So all interest must be declared and taxed in your new country. I personally always tell my clients to retain a bank account in their home country just for flexibility in the future, and also to allow them to manage their wealth and the different currencies that are relevant to them. This might apply to you too. However, be sure to have a local bank account set up to avoid paying any unnecessary card charges when going about your daily life. This could soon be very expensive, particularly if your new country of residence operates a different currency to your home country. Okay, number two, ISAs. So for those who aren't UK nationals on this session, independent savings accounts. Once you cease to be a UK resident, you can no longer contribute to an existing ISA or open a new account. Your existing ISAs will retain their tax-free status, but only for your UK tax position. So if you make any withdrawals, your profits are now subject to tax in your new country of residence. And you must, of course, notify any ISA provider when you move overseas so that they can process your tax treatment correctly. But trust me, in any case, they will find out very quickly. So that's ISAs. Number three is premium bonds. Premium bonds are primarily used as a tax planning tool for high income or high net worth clients in the UK. This is because they pay cash prizes rather than interest, and this means that they are tax-free. But you guessed it, the tax-free status is lost in most foreign countries, making your winnings taxable income. Therefore, holding premium bonds has almost no advantage as an expat, so you should look for a more suitable alternative. Final point here, you do need to retain a UK account if you're looking to cash in any existing premium bonds that you have or would hold in the future. And lastly, number four, pensions. This is actually a world unto itself, and I could and actually have delivered full webinars on this subject alone. So let's try and keep this short and simple as possible. There are two main pension types to consider. We'll consider the state pension and the private pension. So your state pension is unaffected by your move overseas. It can even be paid into a foreign bank account if you prefer, and this would happen at the spot rate of exchange, although you may incur some bank fees here for the reception. Private pensions, such as your workplace pension or stakeholder pension, are quite a lot more complicated, however. So your pension benefits are usually paid net of UK income tax. So if this is the case for you, then you'll need to reclaim a tax credit, as we discussed in the slide discussing tax residency. You'll need to take care when withdrawing your 25% tax-free lump sum, as well as this may now be taxable in your country of residence, so be careful with that one. For both the state pension and UK personal pensions, there is some exposure to currency risk. For example, you may be earning in pounds but spending in euros, which means that the value of your pension will change every month. Some options exist to make your pensions a little bit more suitable for a life overseas by minimizing your exposure to currency risk and also your exposure to UK tax. This starts to get a little bit complex, so please do seek advice if you'd like to review your position. Okay, now we're getting into the really interesting part of today's session. So the financial plan. What is it? How do we build it? Well, first things first, we need to start by separating our financial assets into sections. The way I like to do this is into short-term, medium-term, and long-term assets. We're not considering any property here, just to keep things simple. Short-term assets are fairly straightforward. This is cash held in the bank that you can access at a moment's notice. A lot of us tend to hoard cash in the bank account, mainly for the feeling of security that this brings, but this is not prudent financial planning. We should only keep enough in there to cover day-to-day expenses and any unforeseen circumstances that may arise. This is why financial planners refer to bank accounts as an emergency fund. And this is exactly what it should be to you. The best practice that I would recommend is to keep around 3 to 6 months of expenses in there to cover your liquidity needs. But anything above that is unnecessary and frankly losing you money. Why? In a word, inflation. Inflation is the increase in the value of goods over time. You know, when you go to a supermarket and the price of milk keeps increasing, that's inflation. If your money is being kept in a 0% current account, as the majority of current accounts these days are, then inflation is eroding the value of your money and you should look to do something about it. For example, if you have £100,000 in a 0% current account at just 2% inflation, then you'll have effectively lost almost £10,000 in purchasing power in just 5 years. Would you accept, this is an interesting question, so do consider it, would you accept losing 10 grand in 5 years with nothing to show for it? Probably not. I certainly wouldn't. And that's why we have medium-term investments. So moving on to column 2, these are your assets above your emergency fund that are invested to generate a return. So the aim here is for us to achieve either growth or income or a combination of the two in order to match or beat inflation and grow your net worth. The returns that you see will depend on the level of risk that you take, and your financial advisor certainly should, guide you through the process to set these up appropriately. If he or she does her job well, then they will likely recommend a tax-compliant investment structure as an expat that gives you the maximum flexibility possible when withdrawing your profits and optimizing your future tax position. More on that in a moment, because as expats, you do avail of certain opportunities that non-expats do not, and that's where we can get a little bit more creative with financial planning and where some really interesting opportunities can arise. But before that, finally, long-term assets. These are your retirement savings and your pensions. They exist to allow you to stop working essentially when the time comes and are accrued through your employment or work history. I personally have a dedicated webinar on the subject of pensions that's been recorded in the past. I know that Nigel and the team at Expat Network are considering doing something similar for you in the future. So we won't go into pensions in too much detail today. But if you're enjoying today's session and would like to know more, or would like a deeper dive into pensions, please do reach out. I'm sure we can set something up. In such a webinar, we would likely go through the options available to UK expats, why being an expat when it comes to your pension can be a lot more attractive than if you were still living in the UK. We'd also look at some use cases where it can be more beneficial to leave your pensions where they are in the UK. The important thing here, or the important consideration here, is taking personal advice. Everyone's pension situation is different. Everyone's pension needs are different. So do seek advice when you start looking at moving any long-term savings around. Okay, so we touched on tax-compliant investments as part of our medium-term asset strategy just there. Let's look at this in a little bit more detail. So firstly, offshore investment bonds underpin the majority of offshore investment strategies, certainly when it comes to expats. when we talk about a bond here, just to let you know, we are not talking about government bonds. We are not talking about corporate bonds. What we are really talking about is a tax-efficient investment vehicle that is held offshore. So offshore bonds are sometimes referred to as offshore ISAs, as they are similar in the way that they operate. Certainly from a tax perspective. Of course, it goes without saying that your strategy, whatever that might be, must comply with local tax laws. And when we say offshore, we categorically do not mean illegal or underhand. We are talking about compliant, recognized investing strategies, and they must comply with local legislation. Local legislation, of course, varies from country to country. So, for example, France, where any tax-compliant investment solution of this ilk should be in an investment wrapper known as an assurance vie, or if it's in Spain, a Spanish-compliant investment bond, if I can get my words out, or whatever structure is most efficient in your new country of residence. So, whilst exact structures will differ, the founding principles will remain the same. Okay, moving on now. Why is an offshore investment bond the expat investment vehicle of choice? There are many reasons, and I've sort of listed the benefits here on the screen. This is a bit of a word dump, so excuse me for that. But the first benefit really is that unlike other investments, no tax is ever due until you actually withdraw from the bond, not when profit is made. So this means that you can defer your tax ultimately, which means that you can grow your money faster. This is known as gross roll-up in the industry. Essentially, imagine a snowball running down a hill. If you were to take snow out every 5 meters, which is the equivalent of taking tax out of an investment portfolio, then that snowball will never get as big as it could be by the time it reaches the bottom of the hill. So that's what we're talking about here. The tax is only due when you actually withdraw from the bond, and because it's not due every year or periodically, the amount in your portfolio can grow larger. Secondly, there are a number of tax planning opportunities that come with these bonds, which allow you to reduce, or in some cases even eliminate, your tax bill, particularly if you are still internationally mobile as an expat. That depends really on where you are looking to base yourself in the future, what your movements will be, but holding your portfolio offshore can give plethora of advantages when it comes to that particular use case. This also extends to your inheritance tax planning position. So not surprising when we consider that these bonds are usually actually set up as a life insurance policy. Won't go into the technicalities of why just now, but that's an interesting quirk of them. It's extremely easy to gift some or all of the bond to a family member or a child. These bonds are also highly internationally portable due to their offshore nature, which means that you can move to a new country and in most cases, not all, but most cases, conserve the beneficial tax treatment. How much really depends on the bond in question, so be sure to ask your financial advisor about that point. And the bond provider will usually, I say usually, they will usually declare and pay all tax liabilities for you as they arise, so you don't have to. This ultimately means less administration, less time wasted with the tax authorities, less time wasted with your accountant if you have one. So this is good news all around. Okay, let's look at an example now. So in this case, we'll use the example of an expat in Spain using a Spanish compliant bond. We'll use this example simply because it is a straightforward one, quite easy to understand. On this slide, I'll show you why the offshore investment bond is more favorable than a non-compliant investment, such as a non-compliant investment bond, for example, or other similar non-compliant portfolio. Now, let's first take a scenario where we can put the money into an account and leave it there. For argument's sake, in this scenario, we are invested in funds and shares and we trade on a regular basis. Okay, so in year one, let's say that we make a profit of, so the 150K investment becomes a 160K portfolio value at the end of year one. If we realize these profits, for example, by rebalancing the portfolio or by changing our strategy, then these profits would become taxable in a non-compliant investment vehicle. Tax is charged at between 19 and 23% in Spain, just to continue the example. So in this instance, we would have a tax bill of almost €2,000 for the year. The same happens again in years 2 and 3. However, if we held the investments in a tax-compliant strategy offshore, as I mentioned in the last slide, we can trade freely and rebalance the portfolio as often as we like, or change the strategy as often as we like. And the profits will only ever become chargeable when we make a withdrawal out of the bond. So in this example, of course, we are not making any withdrawals, so there is no tax to pay. Okay, so that's quite an easy example to give. But what about the second possible scenario where you do want to make withdrawals? Again, there are tax benefits to this approach. So in a non-compliant investment, all profits are taxed as soon as they are realized. So we have the same picture as the one before. With a tax-compliant bond, however, a percentage of your withdrawal is treated as a return of capital. So for example, in year 1 here, if we have 10K profit in our 160K portfolio, then 6% of our portfolio bond is profit, not 100%, as would be the case with a non-compliant investment vehicle if we were withdrawing the profits. And therefore, if we're only paying tax on 6% rather than 100% of the withdrawal, then of course the tax bill is much lower. So as you can see here, €119 instead of almost £2,000 in year 1. And we're looking over here. Again, the panorama or the scenario will change according to the country, according to the type of investment, tax-compliant investment vehicle that's being used for that country. The rules will differ, but this just gives you an example of how powerful offshore investing in a tax-compliant way can be. Okay, so hopefully that's a good taster of the tax benefits of investing in such a way. Of course, like I mentioned, it does vary country to country. A couple of final points on this particular example. So one, you can gift segments of your compliant bond to anyone else at any given time. Usually, it depends. Some investment vehicles don't allow that. The more low-cost vehicles don't allow that, but most of them do. And you can do this before the profits become taxable. So this is great, for example, if you have children going to university in a separate country. Let's say, for example, that they plan to study in the UK, a very common use case, actually, given the strength of UK universities. In this case, you could give one to all of your children part of your bond, and they can use it to generate income, or they can withdraw from it for income to pay for food, accommodation, living costs, whatever they need whilst living in, for example, the UK. The money will then be subject to UK income tax in this scenario. And of course, in the UK, we have a personal allowance of £12,500 before any income tax is due, even more if they do not have any other income sources. So this means that your child can withdraw up to £12,500 of investment profits per year and not be taxed on any of it. So you see what we've done here? We've instantly eliminated your tax bill for your investment profits, and completely legally too. And that's just one use case. There are other ways of structuring withdrawals in a very, very tax efficient way to do something similar. Another use case would be for UK expats. So as mentioned in the previous slide, if you relocate again before realizing investment profits, you may be able to withdraw them completely free of tax under time apportionment relief laws. This, of course, depends on the jurisdiction that you move to. If you go to a jurisdiction, for example, where no tax is paid, then it's fairly easy to eliminate the tax liability. And then there are other strategies according to the place that you end up moving to. So the strategy that you'll need varies according to the new country of residence that you may be moving to. So it's best if we don't get too complicated here, because believe me, we could get down a little bit of a rabbit hole. But long and short of it is that with compliant bonds, you have far greater flexibility when it comes to your tax planning options. Again, I would implore you to speak to your financial advisor just to see what you can do in your personal circumstances. Okay, so I hope that example was useful. Our final topic for today actually concerns property. So this is a little bit of a curveball versus what we've been discussing up to now. So specifically, I'm going to ask the question whether it makes more sense to rent or to buy your new home overseas. So it's fairly common wisdom. I'm sure you'll agree that when getting set up in a new country, it's usually better to find your feet by renting a property while you identify, number one, where you'd actually like to live long term, because most of us don't understand where that's going to be when we first make the move. Number two, what your day-to-day living expenses will look like. And number three, what type of property you'll actually want to purchase for the longer term when the time comes. However, is renting only until you're able to buy really the right approach for you? Well, many expats, particularly UK expats, tend to think that the answer is always yes. This is usually a cultural thing. For example, an Englishman's home is his castle. We all know that old cliche. We love the feeling of ownership. It makes us feel safe. However, in investment theory, something known as the 5% rule exists. This rule, the 5% rule, is built on the founding principle that investing in financial markets secures capital growth faster than investing in real estate over the long term. And over the last 100 years, this has proven to be overwhelmingly true. So the rule is essentially the following. If your annual rent, and of course your annual rent is your monthly rent times by 12. If your annual rent is 5% or lower than the value of the property, then it makes more financial sense to continue renting and invest your available capital in financial instruments instead. And of course, the inverse is also true. So if your annual rent is over 5% of the property value, then you are better off purchasing the property instead. So let's take a practical example with a house valued at 300,000 euros here. So 5% of 300,000 is 15,000 euros of annual rent, or 1,250 euros per month. So this is very, very straightforward. So if the monthly rent is less than 1,250 euros, then you've got a good deal there. You should continue renting. However, if the monthly rent is over 1,250 euros, then you should consider, instead of continuing to rent, buying a property, either that same property, if you're able to, or a similar property in that sort of price range. And that would be a more prudent financial decision. So anyway, the 5% rule is intended as a rule of thumb only. Of course, there are a few assumptions in there. It dives into investment theory a little bit, so maybe a little bit beyond the scope of today's session. So do get in touch with me, with a colleague, with someone else, if you'd like a personal analysis, just to make sure that you're making the right decision before you take the plunge and buy your overseas property. So that's an interesting consideration that I just wanted to flag up before we close the session and start talking through your questions. So that's pretty much it. Of course, as this is the Wealth Management Essentials session, like I mentioned a couple of times here, we didn't dive as deep into individual topics as perhaps we otherwise would or could have. There is a lot to fit into a short amount of time, so I hope you at least found it informative, and perhaps today's session has given you some food for thought on where to focus your attention as you get your finances in order for life as an expat. I know we've got some Americans in the house today, so just as a final note, Americans, you do need to make sure you're complying with American legislation as an expat. It is a very difficult spot to be in as an American because of things known as FATCA, because of something else known as the PFIC laws, which basically makes investing outside of the US very complicated. So do speak to an advisor that is specialized in certain matters. I know that the majority of people on the session aren't American, so let's not dive too much into it unless a specific question comes up. Like I mentioned, if you would like a personal assessment of your circumstances, I do give out free financial reviews, particularly to readers of Expat Network. So these can be booked at the time that suits you best. You can get in touch via email. My email's on the screen there. So it's jonathan.ralph@holbornassets.com. And that's my Spanish mobile up there. So if you need me as a matter of urgency, you can give me a call or also send me a WhatsApp. And I'm happy to help in any way that I can. Right, Nigel, can I hand back over to you, because I think it's time to open the floor to some questions.
Yes, thank you very much, Jonathan. Yes, we do have a few questions here. Firstly, this person says, I'm 58 and planning to retire in the next few years. How should I adjust my investment strategies as I get closer to retirement?
Oh, okay. That's a good question. 58 is an interesting age when we start talking about financial planning, particularly as retirement's not too far away. I know we don't like talking about getting older too much, but it is around the corner. So your focus should really be at this stage shifting away from more aggressive investment growth and more towards income. So if I were your financial advisor, I would suggest that we start to gradually take the risk off the table, move you into more reliable income generating investments that allow you to budget with confidence in your retirement. So that would mean, I'm not sure how you're invested now, but it would mean ultimately reducing any exposure that you have to high risk funds, increasing your portfolio's weighting towards bonds, fixed income holdings to give you a bit more stability as you start withdrawing an income from your portfolio.
Okay, thank you. Another question here. I'm currently working in Hong Kong, but expect to be transferred to several different countries by my employer over the next few years. Ultimately, I expect to retire in the UK. Should I base my investments on the UK or should I take a more international approach?
Aha, great question. Great question. And given the topic for discussion today, very, very pertinent. So I think you may have an inkling as to what I'm going to say here, but as an expat, you do have a golden opportunity to invest offshore. So by investing if you invest offshore, but know that you'll access your capital when you're back in the UK, then you can grow your investments completely free of any tax, as we discussed. And yes, when I say this, I mean 100% legally. As discussed, there's nothing underhand about doing it in this way, provided you use a reputable advisor, a recognized provider, and do so in the right way. And then when you move back to the UK, there is a really interesting tax break that's known as time apportionment relief. I don't want to bore you with the jargon, but time apportionment relief essentially means that any gains that you make in your investment bond, an offshore investment bond, while outside of the UK, will not be subject to UK tax. Therefore, if managed correctly, you will not pay any tax on these investment gains during your time overseas. So it may be tempting for you to invest in the UK if you know that you're going to end up there. Excuse me, but if you do this, then you'll be exposing yourself to an awful lot more tax in the long run. So I would urge you to look offshore. I would also urge you to discuss this with a dedicated advisor such as myself or one of my colleagues here at Holborn Assets, who I'm sure will be very happy to assist.
Okay, moving on to the next one. I have a military pension. Is it liable to tax in France? I think that's a UK military pension, I'm assuming. As a follow-up, would this be the same in most other European countries if I moved elsewhere?
Okay, so tax in France in particular can get a little bit scary, but this is quite a straightforward one actually. So UK government pensions, that includes military pensions, are taxed at source in the UK. So the pension income still has to be declared in a French tax return. But as we discussed when we're talking about tax residency, you'll be given a 100% tax credit to ensure that you're not paying tax twice. So to answer the question, yes, your military pension is liable to tax in France, but no, you won't actually be paying it. If you do have any other income, please bear in mind that your military pension will contribute to your gross taxable income. So you may actually find yourself being pushed into a slightly higher tax band. So yeah, and just a note as well, because I know we're talking about France, but this is actually the same situation in any country with a double tax treaty with the UK, which, as we touched on, is in practice almost all of them. So you can consider this case in your situation wherever you are in the world.
Okay, the next one I have a UK defined contribution pension fund. As I'm moving to Spain, should I transfer it into a CUROPS or leave it there?
Okay, so that's quite a complicated question. This is actually why I'm a little bit reluctant to address pensions too much on this webinar. I would need to speak to you personally in order to give you the best possible advice on this. However, I can give you a couple of general pointers. So the main reasons that you'd want to move a UK defined contribution. Nigel, you did say defined contribution pension, yes?
Yes, defined contribution.
Defined contribution, okay. If it's a defined contribution pension, the main benefits of moving to a CUROPS would be, well, it's threefold really. So the first one, as I touched on, is elimination of currency risk. So if you're spending in, for example, euros but earning in pounds, then the value of your income will change each month as the exchange rate moves. So this can be quite unsettling in retirement, as most people tend to value having more stable monthly incomes. Just allows you to budget and feel a little bit more tranquilo, as we say in Spain, a little bit more comfortable. So that's the first benefit. The second one is to escape the UK lifetime allowance. So in the UK, if your pension pot is worth more than just over £1 million, or is likely to be so when you retire, then you'll be subject to a special tax in the UK. If you transfer into a CUROPS, you can mitigate or eliminate this potential tax charge. So a good time to transfer into CUROPS is just before you hit that ceiling. You move it over, and then it continues to accrue over and above the lifetime allowance. And then, from a tax planning perspective, that's very efficient. And then thirdly, the third benefit that you want to consider when moving into CUROPS is consolidation. So most people work in different places throughout their career. So most people have various pension schemes in various places. That can get a little bit unmanageable after a time. So consolidating everything into a CUROPS can be useful. It puts all your funds into one manageable place. And then, of course, euro denominated if you're living in Europe. So that makes it much easier to define, a withdrawal strategy. It also makes it much easier to define a good investment strategy because we're dealing with one pot. There are also some minor additional administration benefits that come with a CUROPS. Those are the three main points to bear in mind. But like I say, always, when it comes to your pension, seek qualified regulated advice before you do anything.
Okay, thanks, Jonathan. One more question here at the moment. I think this is the last one we have currently, unless anything else comes in. I'm thinking of investing in a buy-to-let property in the UK to keep an interest in the UK market. Will this result in any tax issues in the UK as an expat living abroad?
Well, that is timely. Now, this would actually be an excellent question for my colleague Jason to answer. So Jason Swan, my colleague in Spain, he's actually giving a dedicated webinar on UK property investment as an overseas resident with you, Nigel, and Expat Network in a few weeks. So Nigel, I will let you plug that session when we finish.
Jonathan, it is with us, but it's in a few days. It's on Thursday.
Oh, it's on Thursday. Oh,
yes.
I got my calendar wrong. I need to put that in my diary. Apologies for that. Well, if it's on Thursday, then there's absolutely no excuse for everyone that's interested in property from attending. If I could just answer that question then, just to give you a bit of a snapshot, and then of course Jason will go into much further detail. I believe he's with someone else from our company, Chris Allen, on Thursday. So if you are not resident in the UK, then you are still liable to UK tax on rental income that is generated in the UK, basically. This will be paid at a basic rate of tax, so 20%, and this will either be paid by the tenant directly or more likely by the lettings agent that you use. So you will then declare the income as usual in your country of residence, and once more avoid paying the same tax twice under the double taxation agreement that your country of residence has with the United Kingdom.
Right. Okay. Well, thank you very much, Jonathan. I think that's the last of the questions, yeah. So many thanks, and I'll call an end to the session there. Okay.
Well, can I just say, Nigel, great questions. It's good to see people that are engaged with what we're talking about. So I hope everyone found the session useful and interesting. And yeah, thank you for your time this morning.
Yep. Okay. Well, one thing just before I leave is, at Expat Network, we sort of are here to support people. And if you have any questions, or for us or for Jonathan, and you haven't managed to get his email address there, you can always contact us at expats@expatnetwork.com. Okay. Well, thank you and goodbye.
Thank you.